Hi, everybody. Welcome to PFA's Q2 halftime report. Another busy, exciting, crazy quarter going on. Today is May 23rd. Going to give you an update on what we've been seeing in the economy and in the markets so far this quarter. As always, I am joined by our fearless leader, James Bradley. How are you?
Happy second quarter, Sam. I'm doing good. How are you doing?
Doing well, thanks. Headed into Memorial Day weekend here, hoping for a little bit of better weather to come around, but hope everybody has a good one. All right. Keep it moving for everybody. Jumping in with our economic scorecard right off the bat, as we like to check in on each quarter. Much more of the same here, largely. Overall, the economy, the economic data in April pointing towards expansion still. Did see a little bit of deterioration in profit margins, but overall, still really good here. I think last quarter we said, barring any economic shocks, we're not expecting there to be a recession this year, but that was a big if. Especially with this administration coming in. And lo and behold, we did get some economic shocks, so we'll be talking about those. We had also warned that there might be a negative GDP print for the first quarter, and that actually did manifest as well. But here to show you that that's not as big a concern as it might sound like on the headlines. As you can see here, real GDP did dip slightly, 0.3%. Normally, we want to see that between like 2 and 2.5% over annualized. But consumer spending was still strong. Investment was still strong. Not a big change in government spending or exports. Where we saw the big dip was in imports, which is actually a negative factor on GDP because that means money is leaving the country instead of coming in. So what was going on there was a lot of companies trying to front run the tariffs before they got added on, building up their inventory so they wouldn't have to purchase during this volatile time where tariffs are on today, off tomorrow, doubled Thursday, half Wednesday. So that is what was going on there. Looking forward, looking at the Fed numbers from the Atlanta Fed, they're expecting us to bounce back pretty quickly here in the second quarter with an annualized rate around 2.4%. So this looks like more like the anomaly going back to what was kind of normal growth before that here in the second quarter, still on a slightly slowing growth trajectory, but certainly not falling off a cliff as this report on the headline might suggest. But circling back to the economic shocks, recession probability has come up a little bit. When we look around now, we're seeing around 20 to 30% probability of recession over the next 12 months. So we do want to throw that out there. And the reason for that is all this uncertainty around fiscal policy. The Trump administration is certainly coming hot, I think, as a lot of us expected. Trade policies, tax policies, deregulation. There's a lot going on, and trying to figure out the net effects of these things is very difficult, if not impossible. But we're going to try to break down what is going on and some of the potential effects coming out. So Jim's going to talk a little bit about tariffs first.
Yeah, before jumping on to recording this, Sam and I were talking about our view of the economy and how it was impacting a couple of the house projects we're working on. So we'll call this the Bradley Chaplin recession indicator, is kind of flashing a cautionary tone there. The obvious gorilla in the room is the tariffs that have been imposed, or at least introduced by the Trump administration on April 2nd. And the net impact of that was to bring tariffs up to really their highest level since we've seen prior to World War II. Anybody who's watched Ferris Bueller is certainly understand Smoot-Hawley and that type of thing. Following, what happened after that, the first thing that happened was the stock market really rebelled pretty significantly. And we went into a bear market by a lot of estimations, with about a 20% drawdown on stocks. But interestingly enough, it wasn't until kind of the bond market vigilantes really started to step into the picture and send bond yields up that really kind of seemingly shook the administration, caused a 90-day pause on tariffs being announced. Whether this is the first of many 90-day pauses, or whether we look at sometime in early July, going back to the high levels that we were going to be looking at, is yet to be seen. But yeah, the initial tariffs brought us up to an average of about 28%. That 90-day pause brought us back down to a level that was certainly higher than anything that we've seen since World War II still, but relatively lower, 13%. Where do tariffs take us? Do they cause inflation? Most economists would say yes. Could they be recessionary? A lot of economists say yes. And when we put those two together, could we look at an outcome where we see a not so great combination of both of those things happening with stagflation potentially? There's always a concern about an upward pressure on prices being as the result of this, but if there is a downward pressure on growth, could those offset one another? And could we be looking at a situation where slower growth causes prices not to jump up quite as much? Net effect really is to be determined. So bottom line is we don't really know yet, but we're certainly paying attention and trying to figure that out from a standpoint of our investment policy. And we'll get, I think, some degree of greater clarity, if not over the course of the next few weeks or months, it's certainly over the course of the next 12 months as to what direction that's going to drive things in. The recent forecast from JP Morgan, shows that tariffs alone on their own is certainly putting downward pressure on domestic growth, especially domestically. And so we look at the slide that we're seeing here, the blue portion represents the decrease in the percentage of GDP growth percentage as a result straight out of the tariffs. But interestingly, you add another leg down in potential growth because of the uncertainty that's created there. And that's that very uncertainty that I was just talking about, whether or not we're going to keep the tariffs in place that are there, or whether they're a negotiating tool for other trade concessions, whether or not these become inflationary, like I say, or limiting on growth. A lot of that's yet to be determined. And that's why, not having that clarity can really bring down growth in and of itself, while people like Sam and I wait to make purchases and jump into projects. And certainly on a grander scale, as Sam showed in the recession indicators, as purchasing managers longer term just try to decide where to deploy capital, that can really slow down domestic and international growth when it comes to GDP.
Great. Thanks, Jim. Yeah, I'm going to expand on that a little bit because tariffs have definitely been front and center, but they're not the only changes going on within fiscal policy. It seems like everything is shifting the ground below us. Tariffs being a big one, likely to put some upward pressure on prices and downward on growth. What's the net effect there? And then we're going to expand and zoom out a little bit because this is really, Treasury Secretary would call it just one leg of their three-legged stool. The other two being tax policy and deregulation, which are both aimed at stimulating growth, potentially helping offset some of these tariff pressures in either direction. So you can think tariff might slow growth, but things like tax cuts and deregulation would encourage growth. So trying to find the net effect of all those things is even harder, particularly where we really don't know yet what's going to be in the tax policy and deregulation bills that are coming through. We did get kind of our first look at the bill that passed the House this week. What we see in there is largely to be expected for the most part, just tax cuts on one side and being paid for by some cuts in education and healthcare, but a whole lot of deficit spending here projected to be about $3 trillion over the next 10 years. So for, a fiscally conservative type of Republican, this is going to be an issue when it reaches the Senate, and we're likely to see more changes there. So we can't bank on this by any means, but there are some concerns that if things are going well, why are we still spending so much out of the deficit? Those promises of massive government cuts to offset tax cuts haven't really come through yet. So there is likely to be a whole lot more borrowing in the government's future. So how has all this fed into markets so far this year? We took a look at this next slide. It's going to be equity returns year to date. In the blue line, we got international equities. In the teal line, we have domestic equities. International equities have continued to outperform. They started with the benefit of much lower valuations and made them less subject to these shocks that have been going on with U.S. fiscal policy. And their policies are also more certain than what we have here in the U.S. So there's a lot of risk associated in the U.S. with just a wide range of outcomes that could happen over the next few months. And not a lot of certainty about what those are going to be. When people see that type of wide range of outcomes, they pull back on the risk that they're taking. And that's put some pressure on U.S. markets. Following the Liberation Day announcement on April 4th, there was a big drop in the U.S. markets. A lot of U.S. investors were liberated of their money, but there was a quick turnaround when that 90-day pause came through. And at this point, markets recovered to the point where it sits almost where it started the year. So we find that pretty interesting that at this point, the markets have look through some of the tariffs again. As when those tariffs were initially put on, nobody knew if they were actually going to be held indefinitely, or if it was more of a bargaining tactic to get people to the table and negotiate better deals. At this point, it's looking a lot more like the latter. Actually, as we sit here today, there was a Trump announcement that he was threatening 50% tariffs on Europe, and the market barely budged. So I think his political capital there, market capital on moving the markets the way he did back on Liberation Day has somewhat expired, and people see that it is a bargaining tactic, art of the deal, as he would call it, to get people to the table and negotiate better deals. So that is where we sit now. It's been a great year for diversification, which last year was not so much when we had all the gains concentrated in a handful of companies. This year has really shown why having allocations to international markets and value stocks and small caps and all those type of things can benefit you when there are these large shocks. Because when the market rally is all concentrated in a couple companies, those companies get highly valued and then are susceptible to these shocks when they do eventually happen. So that is a little update on the equity market. But like Jim said, the bond market's kind of been more of the adults in the room, as tends to happen, and has kind of swayed policy with the way the moves have been going there. So he's going to take a look at how the yield curve has changed since the last quarter.
Yeah, counterpoint to the equity markets, which internationally have done extremely well over the course of the year. It has been the bond market, and you can see that on the graph here. The purple line is the yield curve that we had at the end of the last quarter. The orange line is where we essentially are today. And you can see that just pretty much across the whole yield curve, there's been an increase in yields. And as we know, that's from all of our lecturing about this in the past, just remember, yields up, prices down. So that's left bondholders a little bit behind where they were before the tariffs were announced. And why? Well, I always look at the short end of the yield curve as pretty closely tied to what the Fed does as far as interest rate policy. Going out a little bit, it's a little bit more of a reflection of where investors see prices and yields going in that period of time. So when we see, 1 year to 10-year yields starting to go up a little bit higher, that can be related to investors factoring in higher rates, perhaps as a result of inflationary concerns. And then when we go out to the really far end of the yield curve, those 30-year yields, that's quite often an indication as to what just global investors see as being the desirability of owning U.S. debt. And the less desirable they see it for their portfolios, the higher those yields have to be in order to encourage investment in them. And so the lower the prices end up being for those particular longer term instruments. So yeah, when President Trump mentions the bond market, quote unquote, getting yippy and pausing tariffs as a result of that, I think that's that longer end of the yield curve is a big part of that, because that's an indication that, a big part of what we've relied upon for the U.S. dollar being reserve currency and that type of thing, that interest in holding longer term U.S. debt is somewhat coming down as a result of the uncertainty that we're seeing here from a standpoint of our own fiscal policy domestically. And with that, just turning it over to Sam to wrap us up with a little bit of a talk on American exceptionalism.
Yeah, I would like to round these meetings out with a little talk about what's going on in the headlines and give you our take. Do you usually take a grain of salt with the headlines out there, financials? You'd think that scary headlines grab a lot of attention, and a lot of attention grabs a lot of ad revenue. So they tend to try to scare people more than they try to encourage them. But one of the headlines going on right now is it the end of American exceptionalism? So I want to do a quick chat on that. Let's talk about what American exceptionalism is. It is the idea that the U.S. economy and the U.S. markets are so exceptional through all the innovation and the efficiency of the financial markets and how large they are that other countries are really forced to invest in us, I would say. So that is the idea of American exceptionalism. And America has been able to grow its power despite a large trade deficit, because a lot of the money that goes out of our country through trade deficits gets recycled back into our country through our financial market. That is one of the concerns of this Trump administration. And I think one of the goals that they're trying to achieve is to rebalance that a little bit, because you can think that if we're buying all our shoes and clothes from China, and then China's coming here and buying all our farmland and real estate and stuff like that. And eventually that's going to have some problems down the road. And that is a really legitimate concern that they are trying to shrink that trade deficit and produce more domestically, both for economic safety and national security safety. So is it the end of American exceptionalism? And we would argue it is certainly not. I would say American exceptionalism might have been a little bit carried away over the last few years. If you look at the outperformance of the U.S. markets and the valuations in the U.S. relative to international. So I think that gap is reverting to the mean a little bit. But we still do have massive innovation going on here through things like AI. We still got some of the highest and safest interest rates in the world that caused foreign investors to need to invest in our money. Still get some of the highest return on capital and strong monetary policy and fiscal policy that gives people confidence in using the dollar because it's so liquid and easily accessible. So I think the fears that American exceptionalism is over and everybody's going to leave the dollar are kind of a fear that pops up every 10 years or so, it seems like. And I don't think this is the time that it's going to completely fall apart. But we do think that it is a good time to own some international equities because there is going to be some mean reversion there where, the valuations in the US probably shouldn't be that much higher than they are internationally, especially if we're making big changes and adding a lot of uncertainty to US policy. So something to keep an eye on, but not something we get carried away with and go ditch in all of our US assets or anything like that, because there is still a lot of opportunity here and will continue to be in our perspective. So I think that about rounds out our meeting for today. Thank you all for joining us. Hope everybody's having a great summer out there, and we'll see you next quarter.
We'll see you next quarter. Thanks a lot, guys.